Hello, and welcome to Reinventing Correspondent Banking. I'm Joy McKnight, Transaction Banking and Technology Editor at The Banker, which is part of the Financial Times Group. And I'm here to introduce the session and also chair the session. I think it's very interesting because obviously the transaction and correspondent banking industry has really survived many storms, none less than the global financial crisis. But I remember doing video interviews at the 2009 Sibos in Hong Kong during and after a real typhoon and following the crisis that cast a long shadow on the investment banking business. And I asked many interviewees there whether this area of banking had finally become sexy. And I have to say, they all said yes, but I think they'd been thinking that for a long time. So fast forward 7 years, and even in the strong, stable, and consistent business is coming under pressure from an increased regulations and compliance, from new customer expectations, from fintechs nibbling at the edges, and also a result of the cyber threats. A perfect storm is a phrase I've heard used a lot this week. But importantly, what we see now is a real and pressing desire to reinvent how banks work together and to ultimately solve their clients' need in a very turbulent and stressful environment, and one where the pressures are not likely to ease in the near future. So that's what we're here to discuss today. I'd like to introduce my distinguished panelists. I have Anurag Bajaj, Global Head of Banks, Transaction Banking, Standard Chartered. Next to him is Philip Bruno, Expert Principal at McKinsey & Company. Peter Klaus Landy, Director of Banking Initiatives, GE Treasury, General Electric Company. And Greg Murray, Global Product Head of High Value Payments at Bank of America Merrill Lynch. And Susan Skerritt, Global Head of Institutional Cash Management and Head of Global Transaction Banking Americas at Deutsche Bank. Thanks so much for joining us today to debate and discuss how to reinvent banking. So this panel actually builds on a similar panel in Singapore last year, which tried to answer 4 questions. Why do we need to reinvent ourselves, and what are the drivers for change? What do we need to focus on now, and how to go about it? And the 4th question was around, when do we have to act and really make a move? So in the past 12 months, the industry overall has taken some significant steps. I think SWIFT's Global Payment Innovation Initiative is one such move. And so today what we're going to do actually is start with sort of an overall view of correspondent banking industry today based on new research by McKinsey, and then hear from a corporate customer, Peter, about his experience and what he needs from banks in order to make his business more efficient. So Philip, would you like to start?
Sure. Thank you, Joy. Today we wanted to just set the table with a few facts and maybe a challenge to commercial bankers as we think about the future. We have put together our next revolution of our global payments map, which looks at the revenues from payments throughout the world and builds this up and looks at it from the current day and projects out for 2020. As we see, we've had some pretty good times in the past. A bit of a market slowdown this current year, but we still see, at least in cross-border transactions, a 4% growth rate going forward over the next 5 years. So a bit slower than what we had anticipated in the past, with some rougher times coming in, with renewed competition, but still a fairly healthy growth rate in cross-border. And if we look at where these volumes are coming from, whether it's volumes or the revenues generated from it, it is no surprise from the business-to-business segment, whether it's in the 135 billion or so, or trillion in volumes, or $240 billion US in the revenues generated from those transactions out of what we anticipate being next year of 365. Now, I think the change that we start to see is in cross-border transactions, where a number of years ago we saw new entrants, particularly on the consumer side. And this is an area where it has some of the smaller revenues and also the smaller share from banks, as these attackers over time have taken share. But what we're seeing is that they're starting to move up that value chain next into small business and small business services. And the smallest of small businesses often need transaction support that looks like consumer. But now we're starting to see that eat into some of the corporate arenas with B2B, and this is the part that is most concerning, given it's where most of the bank revenues are and where banks still maintain 95% share of that market. Now, when we look to the future and our baseline, as we see that growth in the 365 billion that we would expect in 2020, I think we'd look and say, okay, what if we see an acceleration of this environment of attackers coming in? And what would it take to see nearly a 50% reduction in revenue? And so this is a scenario which has 10% incremental pressure on margins and an additional 5% incremental share loss. And that's where most of the attack would manifest itself and come from. So this is a scenario which would be pretty scary. And so as we look forward and say, how might we look at this and what would you need to do if you say, well, this is something that has relatively significant chance of occurring? We always start and say, let's look at what does the customer want, right? And we'll hear from that soon from Peter. But we went out and did some mystery shopping and say, how does the current correspondent banking system stack up against some of the other solutions and some of the new providers that are out there? And really on some of the things like speed, competitive pricing, transparency, these things are relatively poor. Right, as you can imagine, security and compliance, what banks do well, and also this ubiquity, right, that we've built this system to move money to just about any account anywhere, right, that is where it scores relatively high. But if you look at the others, right, particularly around some of the remittance banks, the closed-loop systems, which are the ones in the middle, tend to score pretty well. So I think maybe an idea to throw out there is how do we keep what we have built in security compliance and in the ubiquity, but actually operate more like a closed-loop system where you can control that customer experience a lot better. Right? So it's just a thought to think about as we go forward. Now, what is the challenge on the cost side? Right? If we look and say that a typical transaction cost cross-border is $25 US plus, right? What would it take in the future, right? So we look at this and say if we're trying to get near ACH-like costs in the future, we'd say you would need to take out 90% plus of the cost base, right? Mm-hmm. So this is the challenge, and I would say this is the aspiration, right? Now, a lot of people look at this and say, well, that's not possible, and I would say, well, if we look at Elon Musk and what he's done to automobiles, right? The cost of going from 0 to 100 kilometers per hour and in 2.4 seconds has now gone from, Lamborghini costs of over €500,000 to 100,000, right? He came out with an announcement yesterday that he wants to get space travel to go down below $200,000 US. Right? Those are the aspirations that we have out there. And I think what we're saying here is just being able to take cost out of the system by an incremental approach versus actually taking a much more transformational approach is what's required. Right? So we just say set the bar high.
Okay,
so I think that's just a quick overview.
Yeah, that's very interesting. I just wanted to ask you one question. In light of your research, what is really your prognosis for the future of correspondent banking, and will it still have a pulse in 5 years' time, let's say?
Yeah. So I'm sure it'll have a pulse. I'm not sure if we'll be sexy still.
Okay.
But what I would say is that we still see correspondent banking overall growing revenues at about 5%. So we have 4% for cross-border, but actually domestic transactions, we think revenues will grow at 7%. And average out, given the shares, to about a 5% growth rate, which is where we see payments revenues growing overall. So it's still going to be quite healthy, although not what we've seen in the past. And I think it's up to bankers to really think about how they deliver on the needs of the customer, which are evolving quickly, and doing this in a way that we're able to manage the cost of doing so as we go forward and get to the experience that that I think the customers are asking for and frankly demanding.
Okay. Peter, I think this leads on quite well to you in terms of how has your needs or, what you've needed to get done and be more efficient, how has that changed over the past few years?
Yeah, so I think my expectations have actually changed in the last 2 days after attending some of these sessions here, right? But I think the bottom line is that payments are evolving. We've seen a lot of the rise of the fintechs. We've heard a lot about the new blockchain technology and things like that. But I think the expectations from the corporate side are really, number one, we got to make sure that our payments are safe and secure. The visibility and the transparency into the payment life cycle would be great for us, right? And we lack that today, especially in the cross-border space. And we also obviously want them to be inexpensive. I mean, cross-border transactions are inherently expensive today, $25 to $35. And we also have no insight into the fees that may be lifted along the way today as well. So those are just some other things to take into consideration.
Okay, but how would you rank your experience with international payments at the moment? Is it painful for you?
Yeah, I mean, there is pain points, right? And I think the transparency piece is probably the biggest one for us. I hear a lot on the day-to-day, if we have the speed and transparency, right? But the transparency, I think, is a little bit more important because today we don't have visibility into where those transactions are in the life cycle of the payment, right? So if we're paying a customer, if we have a deal that we have to close, an M&A transaction we have to close, we want to know where that payment is throughout its life cycle. Sometimes, unfortunately, we don't figure out that we have an issue with a payment until we get a call from a customer saying, hey, where's our payment? And at that point, it becomes a manual effort with our support teams to actually get involved, work with our banking partners to track down where that issue may be. And the issue, could be non-eventful. It could have to do with some type of OFAC or AML type sanction hold up at one of the correspondent banks, but we have no insight to that today whatsoever.
Okay, but obviously there's a lot of fintechs that are now playing in this space. Has GE Capital, has it actually looked at alternative payment providers?
We work with our banks and we see what types of additional products and services are out there that are offered. We do look at other vendors and things, but I think at the end of the day, I think it's still one of the big advantages that we have today that over the fintechs is that the wide network of correspondent banks that all of our banking partners have over these fintechs today. So GE being a huge company, business in over 175 countries, we need to make sure that we can consistently make these payments throughout all of these countries, and we can't narrow it down if we can't have that wide breadth.
Great. And obviously you talked about transparency, visibility, and predictability, and that's what the SWIFT's Global Payments Innovation Initiative is, which was launched at the end of 2015, but now has like 75, 80 banks, members signed up to it. And it's updating service level agreements in the initial phase to improve cross-border speed, transparency, visibility, and also to provide more remittance information. Do you think that really solves all your pain points, or has the possibility to solve that?
I think it solves a lot of them. The transparency, the speed is definitely key. The remittance information, like you said, the more remittance information that we can get, the better, especially on the collection side when we're trying to match invoices and things for our receivables. In terms of the speed, today it's an unknown. Bank to bank, we really have no idea how long it's going to take, and it really varies based on where the payment is going. At least with this new initiative now, we'll have some defined SLAs around when the payments will actually arrive at the beneficiary. It may not be as fast as we would like it to be today, but I think it's a step in the right direction.
Okay, but what it doesn't do is really commit to lowering the price. How high up your wish list is it for GE Treasury?
Cost is always a factor, I think, for any corporate, right? But at the end of the day, I think this is a step in the right direction. I think a lot of the pressure from these fintechs and the looks at blockchain and different types of technologies is ultimately going to force the correspondent banks to look at their operating costs, kind of like what Phil said. And ultimately, they're going to have to be driven down in order to stay competitive in the market. So I think that this is a good first step, and I think eventually down the line, the costs will eventually end up going down.
Okay, but it also speeds up the transaction, but it doesn't move actually to real time. And even though there's a lot of real-time, domestic real-time initiatives happening around the world, do you think that's something that GE wants?
Yeah, absolutely. I mean, I think it goes back to the question, for today, for domestic payments, we can send domestic payments at a low cost and near real time, right? So why can't we do that for cross-border payments today? So, it's definitely something that we would like to see. I mean, the faster we can send and receive money, the faster we can reinvest it. So.
Okay, great. Thank you so much. I wanted to bring in now the banks that are on the panel, and I'd like to start with Susan from Deutsche Bank. Just would you like to comment on either what Phil has said or what Peter has said, and how you see the information that they're delivering?
Absolutely, Joy. Happy to comment. So first, let me comment on Phil's presentation, and I want to also comment on how the industry is responding, because I think the industry is well aware of what needs to happen, well aware that we need to be focused on new technology, that we need to make more significant movement forward. And I would argue that the development of the SWIFT GPI initiative over the last year has demonstrated a level of urgency, has demonstrated what the banks are doing. In less than a year, we have made real progress. And now the plan is that phase 2, with the introduction of the cloud technology, will happen next year. So that's a very dramatic movement forward, and I think absolutely the right movement forward. And let me turn to Peter's comments. Peter, thank you so much, because what you said was, first, safety and security, second, transparency. So, and if we go back to Phil's slides, correspondent banks offer the greatest safety and security, and will continue to do so. That is part of our role. We have to ensure that the whole network is safe and secure. We are investing in AML monitoring. We are investing in cybersecurity protection. That level of investment requires enormous economies of scale, and the correspondent banks have that economy of scale. And then if we turn to transparency, which was the second thing, and very understandable why you need that. That's exactly what SWIFT GPI is going to introduce. The cloud-based solution will provide information that corporations, the clients of banks, can use to begin to reconcile, to begin to forecast when they're actually going to receive money. As I think about it, I like to separate the immediacy of information from the immediacy of settlement. And clearly, it would be great if we could do real-time payment processing worldwide. And maybe someday we'll be able to. But in the meantime, what we really need is the immediacy of information. And that immediacy of information is going to benefit all of the participants in the network, but particularly corporate clients like GE.
Great, thanks. Anurag, from your perspective, from Standard Chartered, what are you seeing, and do you want to also comment on some of the earlier comments?
Yeah, it's kind of hard to go after Susan. She's covered a lot of it. And Peter, I'm sorry we haven't met up to your expectations over the last 2-3 years as correspondent banks. But the reality is that we have been distracted. There were other immediate priorities that we were looking at in the financial crime space, in the AML space. And the requirements that you have mentioned have not just arrived over the last 2 or 3 years. They've kind of always been there. And so I think, we are, through GPI, through new technologies like Ripple, we are building use cases and we are looking at solving those problems. And I do think that there's always going to be a challenge given the large number of banks that have to participate in something like this, given the structure of the infrastructure where, it's a point-to-point infrastructure, not a broadcast-type infrastructure, where you will be reliant on the weakest link. But I do have a lot of hope for that. And one reason why I do is because this is commercializable. And it's not just SWIFT putting out something that is nice to have. it is something that our clients actually want, and we can commercialize on the back of it. We can provide different qualities of service for different clients, and we can organize our operations around things like speed and immediacy of payments through GPI. And that will really help in advancing the cause and in fulfilling your expectations.
And Greg?
Yeah, I think what I hear a lot of, and by the way, Susan, excellent job putting some perspective on the situation, especially with your last comment about global scale. Because what I hear a lot in Sibos today, or this week, is either one or the other. Is it correspondent banking or is it blockchain? And I think most of us feel, hopefully I speak for many in this room, that there's a need for coexistence. And I'll pick up on Phil's analogy using the automotive space. I bet you if we raised our hands here, 95% of you would say you drive a petrol-fueled car. That doesn't mean we aren't looking at, as Elon Musk has, electric technology, hybrid technology. They're out there, they're viable, they serve a purpose, but they have limitations. In terms of the scale comment that you made, I would argue that those sort of more those newly innovative cars don't have the level of scale and reach and ubiquity that the petrol-fueled car does. Does that mean that petrol-fueled cars will be around forever? Maybe not. But a lot of it depends on where the technology evolves from. So I think our call here in the correspondent banking space, if we consider ourselves the petrol cars, if you will, we need to make them more efficient. We need to make them cleaner burning, better options, anything that ultimately the customers need. While we also look at whether there's a better way to drive a car, a better way to get from point A to point B. And that's where some of the more innovative technology comes in, which I would include in that, the blockchain concept.
Okay. I think it's interesting what Phil brought up in terms of delivering these services at a competitive price. And obviously there's a compelling need really to reduce operating costs for cross-border payments. But how do you really get from the $25 payment that Peter was talking about via the legacy correspondent banking down to $1 to $2? Like, it seems like there's so much that we need to cut out. So I think we're going to move to a polling question. If you get ready, I think there you have the blackberries on the side tables to poll. So I think what we need to do is, I think we get 10 seconds to do this, and there's 5 answers above. So which one of the following cost components should banks be focused on when thinking about improving back office efficiencies? Is that payments, claims, treasury options, nostro vostro liquidity, compliance or network management, FX costs, or fraud? So we have 10 seconds. I hope everyone was able to vote. So it's payments is the 46% of the audience thinks that, but also compliance is second at 31%. Philip, what do you think about those results?
Yeah, I think it's pretty close to some of the research that we found. I would say that payments, claims, treasury options, particularly things like exceptions, handling, those are the things that are driving much of the cost. Nostro vostro liquidity as well, in terms of the cost of that, is also relatively high in the system if you look at it. And I would say FX and fraud are at the lower end of what we found as well. So this, by and large, is fairly in line with what we found before.
Okay, Greg?
Yeah, I think I'm glad to see that, actually. I grew up in payment operations, and I won't date myself, but let's say I was pre-Swift. But I will say that I'm also not surprised. But to get to what it actually could translate to, and to how we get to those lower price points, I think we have to think about what causes the high cost to begin with. So if you look at the average wire transfer, it's a very high-touch product, all right? We promote to our corporate customers and to our bank customers, leave it to us, right? We'll take care of it. If you haven't formatted it correctly, we'll take care of it for you. And that ultimately drives up a fair amount of cost with respect to how you repair a payment. And a lot of it has to do with bad data that comes in. There's certain data that we can fix and others we can't, such as beneficiary information. So if we pay that payment onto the Benny Bank and it's not accurate, it gets returned, and then it creates a delay and various exception processes that add costs to the equation, not the least of which is the user experience cost that causes the beneficiary and the originator to wonder, has one done a disservice to the other, or has it been the banks in the middle? So a lot of confusion. So one sort of potentially controversial approach would be, again, picking up on something Phil said, when we talked about ACH being a low cost product. ACH is low cost in large part because it's a binary offering. You either have the right information or you don't. If you don't, it's kicked back. End of story. At least I can speak for the US infrastructure. If we took the same approach in wire, we could probably dramatically reduce the cost, but it wouldn't be the high-touch service that it is today. So is that kind of controversial? I would say yes. Would we want to go down that road? I don't think our clients would want that, but it does beg the question as to whether the high price is driven by that. Or could we attack it from a different angle and look at making the quality of the payment information to begin with better? And that's where, again, I think if you look at GPI as a platform with rich data, better data, we can potentially address that issue by improving the process from the start. If you improve it from the start, then ideally the rest of the equation begins to get lower and lower in terms of cost.
So, Joy, I'm afraid I have to take a controversial view with your $1 to $2 per payment. I think we have to be realistic. When we're talking about cross-border payments, there is an enormous amount that goes into that. One of Phil's slides had the component pieces. I don't think that we should be forcing ourselves into a box that we have to get to that level price. What we should be doing is ensuring that we are implementing as much efficiency into the process as possible. At Deutsche Bank, we've implemented artificial intelligence so that our exception processing is actually quite good. And when you look at the correspondent banking business and the payments activity, it's largely straight through. I mean, our straight-through processing rate is over 97%. So in many respects, correspondent banking is fairly efficient already. I think there's a lot that we can do. We absolutely need to keep investing. We need to figure out ways to do our KYC more effectively, to ensure that we're utilizing effectively the tools that exist in the marketplace to improve those compliance and network management forms. But I think we have to be careful that we are not trying to drive ourselves out of the business because there is a significant amount of investment that those of us that want to stay in the correspondent banking business have to make.
Anurag?
Yeah, I think just to make an allied point and not obsessing about costs too much, the reality is that if you look at where correspondent banking is going, there will likely be fewer, larger, more committed players in the next, say, 3 to 5 years, right? So there's going to, and we've read columns in The Economist saying that the number of correspondent relationships have declined over time, the number of correspondent banks operating in a market have come down. So what that means is that there will be wallet penetration for those large 5 players that are willing to invest in staying in the business. So the average cost automatically goes down because now you're talking about more penetration of client wallet and costs which a lot of which are fixed. So the average cost will automatically kind of end up going down. And I do agree with Susan that there is a lot to be done making an end-to-end payment. And as you can see, at least 31% of the people believe that compliance is a big component of it, and it is. And it is an expensive component, keeping track of geopolitical risks in real time and making sure that societies and communities are safe given the threat of terrorist financing and money laundering is a serious exercise. And I don't think that problem has yet been solved by the innovators, and I'm sure they will solve it, but they haven't picked that up yet, and it's clearly not the first thing to pick up in the piece. But there is a lot of work that needs to be done in that space, which is high cost.
Okay, and sorry, go ahead.
I did want to comment on the Nostro and Vostro liquidity observation there, because some of the alternative solutions that are being proposed these days with respect to this new technology aims to address the liquidity challenge. And my own feeling has been that we as correspondent banks manage liquidity pretty well. Could it be done better? Absolutely. But I don't think in the grand scheme of things it's the crisis that we might be led to believe. I agree with Anurag that I think compliance costs would be a better avenue to apply that new technology, because it's only 31% now, but I'm pretty sure it's going to go higher. If you look at the green one, the payments and operations, that's relatively controllable. You know, we each have our own operations. We each apply technology to make it more efficient. It's up to us to make that happen. But the compliance costs are only partially within our control. Mm-hmm. A lot of it is open-ended, and we don't know where regulation will go and what the expectations will be. But it has obviously been, those expectations have been raised gradually over the last 3 to 5 years. So I think that's one of the areas where we need to throw some more of this new technology.
There's a reason that line is red. Yeah. Greg is absolutely right.
Yeah.
But when talking about new technologies, like obviously, Greg, you mentioned before about blockchain and things like that, and Susan, you talked about artificial intelligence. Like, where do you think that they can, especially around blockchain, where will that find a real game-changing element to it within the correspondent banking world? Do you think it has the ability really to reinvent correspondent banking?
You know, we're at Deutsche Bank, we're taking a very practical approach to looking at these new technologies. So blockchain or distributed ledger technology is a fascinating opportunity. But we're being very thoughtful about where is the greatest opportunity? Where is there a significant problem to be solved? And at the moment, we don't see that in the payment space. That may change, but we don't see it in the payment space. We don't see it a great deal in the trade finance space. Where we see the opportunity for blockchain is in the securities servicing space. And we've done a lot of work actually testing that, and we're seeing that there is opportunity for improvement in the way in which securities are settled. But interestingly, we recently announced a project called Utility Settlement Coin Project. And as we were testing the securities servicing process, we found that the one big issue was DVP. The one big issue was you may improve the security settlement, but you've still got this cash component. So the Utility Settlement Coin Project, which is just beginning, is a small project, small group of partners, and we're looking at creating a security which is essentially a reflection of cash. So it's based on cash that sits at a central bank. So it's not Bitcoin. So it's really a derivative of cash. It's a security. And it can be incorporated into a blockchain security settlement process. So I think that's where we're going to see the kind of movement into payments, almost through the back door, where we are solving for something that is truly a problem, where there is truly an opportunity for distributed ledger or blockchain technology, but maybe not directly into payments.
That's actually interesting, because at B of A, we focused on the trade side with respect to blockchain.
Yeah.
And some of you may have seen that announcement with Microsoft and a few others. So we see definitely potential there to take a rather paper-based manual process and apply that new technology toward that. But as you know, with pretty much every trade transaction, there is payments activity that underlies it. So I think your point is very valid in not only the security space, but also in the trade space. I also think where we could be taking this technology, and I also agree with you with respect to whether payments is the problem that we make it out to be, it certainly can be better. But I would say whether you're dealing in new technology or current process, we talked about fraud a few minutes ago. I know it was relatively rated relatively low. But I would say identity management would be another area where that technology could pay dividends. And I'm not, of course, a blockchain expert, but in concept, the idea of consensus as to whether something is the truth or not has, I think, some validity, right? It's like when you shop online. If 9,000 people say that that particular phone is a good phone, chances are it's a good phone. So if we apply that concept to payments and more specifically the identification of the parties to the payment, we may be able to find ourselves addressing some of the costs associated with fraud, maybe even some of the sanctions and compliance issues. As we know, many people have the same name, and yet their payments, good people, get their payments held up by virtue of the fact that someone else, who isn't a good person, has some criminal activity associated with it, or potential criminal activity. So I think if we can leverage that technology to solve who uses the system, who's authorized, who's valid, who's good, we could improve the process regardless of which way the settlements actually happen.
Peter, I wanted to bring you in, and just from the GE Treasury and the corporate perspective, sort of, are you engaged with your banks in discussions around these new technologies and how they can improve your business?
We are, and when we meet with our banking relationships, we do have those discussions. We also in GE have a blockchain study group going on right now to actually investigate potential use cases for us internally. One of the things, I think identity management would be a great space for that. We need to make sure that, we're paying the correct people as well. And I think another area that would be great for this would be potentially around KYC documentation, right? Huge problem for corporates today. Every bank wants different documents. They want it in a different way, in a different format. If we can get that standardized, that if it could be incorporated into some type of blockchain technology, I think that could be a benefit to everybody.
And Anuraj, what do you think are the big challenges for really rolling out, let's say, blockchain or distributed ledger technologies?
Well, I think the biggest challenge is the install base. So you need everybody to participate in order for it to be effective. And that's where I believe that SWIFT has a great advantage because thousands of banks are actually using it, not only for one product type, but for trade as well as securities. So there is an install base of users, which, an incremental solution to a problem in that scenario is slightly easier than reinventing the whole space itself. So blockchain will always have this problem of, it'll depend on the number of participants. In this day and age, not everybody wants everybody to participate because banks don't want to deal with certain counterparties. So you have to have permissioning within the blockchain. So there are fairly large challenges in getting critical mass around this, around what is a fairly, I guess it's a complex technology, right? So you have to think about the local and the regional banks and not always the global players, and whether they will be as quick to embrace and to join these sorts of efforts everywhere.
Hey, and Phil, from your experience or maybe from the research that you've done, is there a positive business case that can be made?
Yeah. So I don't know that we've found it yet, particularly in payments. So Susan, I would agree with that. And I think it's a technology with so much promise that banks should continue to push the thinking, experiment, try new areas, find what's the use case that's going to drive this, and then that'll drive the business case. Mm-hmm. But what I also hear, and I would say two threads that I hear coming out of this discussion, and I do think that also the GPI initiative at SWIFT is leaning in this direction as well. One is start with the customer on this. So what is it in terms of product or services that we can get to, right? That's the here and now, right? Can we get to better transparency on the transaction, right, that Peter talked about? Is there ability to do things like request for payment, stop payments once they've entered into the correspondent banking system? Even more simple things like a payment receipt, right? Transparency on knowing that the payment has actually been received at the recipient side, and that everything is okay. Those are the things also that start to reduce the errors, that start to reduce the calls. Right? Once you do that on the front end, now second, let's move to the cost side. Right? So already let's look at demand reduction. Let's look at what we can do and take the transformational approach there. Once we've started to provide the services that I think the clients are really requesting. Right? Later, we can then, now that we've experimented, we can start to turn to things like infrastructure, where I think that's where the blockchain technology may find, I think, more systemic uses, I'll call it, rather than just inside an individual organization.
Okay, but how do you think that banks maybe can collaborate better with non-banks to provide this end-to-end experience? And here I'm not just talking about fintechs, but I'm talking about the infrastructure players.
Yeah, so good question. I think if I'll add, if I start with the customer and say what are the products and services, let's move to cost. The third thing I think is really thinking about how we open up the system in a more API-based banking way. Can we get third parties, and I don't mean just fintechs, but others who can actually add products and services to this, whether it's analytic-based services based upon the information or things like that. That would be the third piece. The fourth would be moving to this more infrastructure, redo or relook at that infrastructure, I would say, with blockchain and other technologies there.
Does anyone else want to comment?
On the collaboration front, I'd like to add something else into the picture. Might be a bit controversial as well, but just picking up on the feedback from the audience around compliance. And I've seen some good examples of how this can work, but I think we need greater collaboration between ourselves and our regulators. If you look at Dodd-Frank 1073, those of us who lived through that remember it was kind of painful in the beginning, but we got to a better place from two perspectives. Our regulator began to truly understand the dilemma that we would face as banks, trying to comply with the original stipulations of that law, that we physically could not declare the fees for every bank that's in this room unless it's our own bank, right? But on the flip side, we learned from the regulators, and it was kind of a wake-up call, and their feeling was, and they were quite right, is we as banks can do better. We should do better. And I think that, unbeknownst to us at the time, but it certainly fed into our conscious thinking as GPI came up. I think that was one of the seeds for why we really need to do something like GPI. So again, it was a bit painful, but it ended up in the right place. The law was revised to allow us to accommodate at least an initially better experience. But we now have an obligation in 2020 to deliver upon the original intent. And by virtue of going to GPI, I think we can get there. So that is just one example of how we can tackle some of these challenges by having greater dialogue and really understanding each other's perspectives, not just between the banks and the fintechs, but between the banks and our regulators, and I would say even the fintechs and the regulators. We all want the same thing. We all want safety, security. We don't want bad activity coming through our systems. But I think the more we talk and listen, not just talk, but listen, the better, I think, more quickly we can get there.
I think I would probably add one more on that, and that would probably be collaboration between banks and banks, right? I think one of the things that we see from the corporate side, especially in the payment space, is you really got to, you got to balance the innovation versus the standards. And, GE does business in 175 countries. We manage all of our SWIFT connections internally. When we go out to a specific country, and it's heavily regulated, and we need to put a new process in place for payments, each bank interprets regulations and different laws different ways, and that results in pain points on our side because we have to adjust the way that we actually send out the payments.
It's interesting, Peter. I'll just comment that sometimes regulators within a single jurisdiction have different ways of looking at the regulations as well. But one other thing about compliance, I think this is an incredibly important area. So I'm going to suggest something controversial as well, taking it a little bit further. At the moment, there is not a lot of sharing about suspicious activity, and there are legal reasons for that. But I think for us to truly address financial terrorism and money laundering, we need, as an industry, along with the regulators, along with the lawyers, to come up with a mechanism to share information more effectively so that we can, in fact, identify patterns that we're seeing, identify fraud early on. In fact, I think the SWIFT GPI initiative will help with that because when we move to the cloud, we'll actually have information sitting in the cloud to which we could apply big data analysis and do some pattern recognition. But I also think legally there needs to be a better way for us to exchange information and really begin to identify who those bad guys are. Because right now, we have to assume that anything that looks mildly suspicious is a bad guy, and there's a lot that looks mildly suspicious. If we were able to share, I think we could hone in on who the real bad guys are.
The flip side of that is also we need to share some information with our clients because, again, because of legal protection and data privacy, we can't share suspicions with anyone because they are suspicions and we are not a court of law. So what happens these days, depending on the risk appetite of different correspondents, you will find a payment that has been rejected by one is being made through another. Now, ideally, you wouldn't want that to happen. You'd want everybody to be consistent, at least in their approach towards something as serious as suspicion of terrorist financing or any such activity. So there is I think we've been crying out for that for quite a while, and that is some place where even technology can help. We are in Standard Chartered, we are employing big data technology to look at suspicious transactions and to make correlations and inform our KYC CDD process. And one way to do it is actually to stop dealing with clients who keep sending us transactions that are linked to suspicious activity. And we're getting better at it, but collaboration will take it all the way to the next level.
Okay, great. So we're going to move on to sort of what's coming next, and we have another poll question. So in a year from now, shall we bring up the poll question? And again, we have about 10 seconds. In a year from now, do you believe your transaction banking business will be smaller or bigger? So please vote now. Okay. Interestingly, last year, about 70% of the audience believed that their transaction banking business would be bigger in 5 years. Obviously, this year, it's about 65%, which is still quite a large percentage. Anuraj, where do you think growth will come from?
Interest rates. Apart from that, like I said, I think there is going to be significant consolidation in this space over time. The serious players will remain. We've talked only about, or mostly about payments. Correspondent banks also play a very large role in facilitating cross-border trade activity and access to local communities and local financial systems. I think that's really, really important. Every large correspondent bank, apart from payments, which is obviously the bread and butter, has to build a niche in that space on how do you enable the access of cross-border activity for your respondent banks or for your clients. So the consolidation and the associated distinctiveness that every correspondent bank will provide will result in deeper wallet penetration of clients. Mm-hmm. And I do believe that because of that, there will be a growth of the underlying activity. Now, whether or not that translates into revenues is again hugely dependent on interest rates, on payment margins, etc. But I do think that bigger is, I guess, 65% of the time the right answer.
But obviously, there's the big issue of de-risking and pulling out of certain jurisdictions. How do you think that will play out? Maybe I can address this to Susan.
Sure, I'd be happy to comment. So, first of all, Joy, I think it's very important that as a bank like Deutsche Bank is looking at risk, we're not looking at a full jurisdiction. That's very important. We are not exiting jurisdictions. Rather, we are doing a risk-based assessment based on the controls that we have internally and the controls that we see among our clients and counterparties, and making any decisions that we have to. And these are decisions that correspondent banks have been making for years. So a very important distinction that I want to make. I'd also like to go back to this question of smaller versus bigger. I would argue it may not happen in a year, but I think given the economies of scale that banks need to have and the investments that the largest banks need to make, I think the reason that the majority is bigger is because there are going to be fewer correspondent banks. And I think that means that there's going to be more activity flowing through a smaller number of banks.
Yeah, I would agree with that. I think it's ultimately driven by the risk agenda. But I also think we have a danger if it gets to that point, because if everyone is de-risking and potentially shedding relationships in developing markets, which is already happening, as evidenced by some of the surveys that the World Bank has done with the BIS, there's a global economic impact. Because as we know, whether it's trade, whether it's payments, that fuels everyone. That fuels the entire global economy. And as more and more of the developing nations who produce goods at low cost are not able to get providers of services to them, we may see either a shrinking of global trade, or whatever trade exists becomes more expensive. So I think we need that, and that goes back again to my point earlier about dialogue with our regulators and understanding that the consequences of certain actions could have unintended consequences elsewhere. So one might be an agenda of fighting financial crime, but the other might have an agenda of ensuring economic stability and growth, and those have to be balanced.
And Greg's right. And I think it's incumbent on us in the correspondent banking industry to also make sure that we are providing information to our banks, to our counterparties and clients about what they need to do. I think several of the banks here have participated in forums. I've certainly attended forums put on by the Financial Stability Board where it's clear that central bankers in certain nations and the banks in those nations need to understand what kind of investment they have to make, what kind of processes they need to put in place. Mm-hmm. And so that continued communication, that continued education is really incumbent on us to ensure that there is that robust global economy that we have to have.
But can I just bring Peter in? Like back to Susan's comment about maybe there's going to be less correspondent bankings. How will that impact your business?
No, I think that's a really good point, and I think we're already seeing that today. So GE does business in a lot of emerging markets, and even some of our existing mature markets that we deal with certain banks. I think they just find out that, correspondent banking is probably not their bread and butter, right? So we've already had cases where, banks in certain areas and countries and regions are actually pulling out right now, and it's forcing us on the corporate side to relook at our banking strategy globally and rationalize the banks that we're dealing with.
Mm-hmm. And Phil, just back to where will the growth come from? Where do you think that transaction banking will go in the future?
Yeah, so I think we see some of the underlying fundamentals still remaining quite healthy, right? So the growth in the number of transactions, that'll remain strong, and the transaction-based revenue. But NII margins are going to come under pressure, right? And it will be geographic-based. I think certain geographies will see more, right? APAC certainly is going to have continued pressure, right? We saw overall payments revenue in APAC decline by 2% last year, and that was due to the change in interest rates. And I think as we get the competition, the margins are going to be much tougher. That said, and I think what some of the panelists are saying is, we're seeing compliance burden, we're seeing the investment required, we're seeing what's going to be required in digital. So the bar to have an acceptable return on capital and to ride this ride keeps getting taller, and that is going to be a challenge for institutions which get caught in the middle, which either don't have a very specific niche play or a lock-in in some maybe domestic business, and don't have the ability to invest and do what it takes from a scale perspective. Mm-hmm. And so I think that's where we may start to see some of the shakeout at an individual institution and provider level.
Okay, great. I'm going to open it up to the floor. I think we have time for maybe one or two questions. I know there's roaming mics. And if you would like to give your name and the institution that you're from, that would be great. Do we have any questions? Oh, sorry, we have two over here. There's one in the front here and one at the back as well.
Hi, everybody. Thank you very much. My name is Amir Rashdi from Abu Dhabi Investment Authority. My question is, I didn't hear you mentioning anything about your competitors. For example, the exchange money houses and Western Union, or there are many, too much of remittances is going through them and corresponding to other banks. So I don't know, your study, for example, did not give any information about those competitors to the bank correspondents. Thank you.
Yeah. So you're saying on the consumer side or remittances? Okay. Yeah. So I think as we look at just some of the research, we would look in saying there is a potential for at least in the next 5 years another 5 points of share loss to some of the competitors in that space, and so that's what it would be. That would be the second largest factor in the decline. But I do think what that extra competition will do is going to force downward pressure on the margins, right, in the services that the banks provide. So it's sort of it's two cuts that competition would provide. Yeah, it's not necessarily faster handling, but it's often that service provision to the bank. So at least from a service mentality, they tend to provide that service, and so that's where we're seeing some of the innovation. The network is much more narrow, so where you can actually find the availability for those transactions, they're providing good services. But on the other side, they're not. They just don't have the network utility that the banks have. And I think that's where we say, for the banks, you have a couple years until they start to build this out. And that's why I think the GPI initiative ran to the point where I think the banking community has woken up and is looking at this and is no longer. I would say a year ago they were just sitting on the sidelines with a watch and wait mentality. That's not the case anymore.
Yeah, I think just to pick up on that, I think where the money service bureaus and even the alternative payment providers have done very well compared to the banks is they have focused very smartly on the user experience, to your point about service, right? I've been a PayPal customer for longer than probably I should, but nonetheless, I joined PayPal because I found it very easy. Yet the underlying settlement is completely transparent. Or completely opaque to me. I don't see it. I don't deal with it. The user experience I have is if I have to pay a friend of mine, it happens, and that's it. The sign-up process is pretty straightforward, and I think it would be the same with an MSP. You have a network that you've built of people on that network, and the settlement is completely invisible, if you will, to the end user. Whereas if you are a bank customer and you go online, or especially if you go to a branch, the amount of information that is asked in order to move money from their account to another bank in another country, SWIFT BIC code, what's a BIC code, all that information is trouble for them. They don't quite understand it, nor should they. So I think that's where we as banks have to focus, is less on the actual underlying rails, because I think those work pretty well. Could they be better? Yes. But the user experience needs to improve. And that's, again, back to Phil's point, where GPI comes in, because when it comes to transparency, visibility of fees and delivery timeframes and service levels, all of a sudden it just opens it right up, and now you've got a better user experience.
Okay, we just have one more question at the back.
Thank you. Mike Baldwin from Westpac Bank in Australia, and you can make it as long or as short as you want, but for Philip, you talked about the transaction price needing to come down, and it's a price issue, not a cost issue, but I think the elephant in the room is that banks make way more off the FX margin than the transaction price, so on international payments. So where do you think the FX margins need to go? And if you have time, Peter, what do you think about that as well?
I wish I had that crystal ball. I do think that is going to be just a continuation of the competitive pressures that we see. I don't know that I see any discontinuity impacting that, but I actually defer to the bankers in the room.
Time's up.
Peter, did you want to come in?
I agree with a lot of what Phil said, and I think, again, the more pressure that's put on the market, I think it's naturally just going to force the prices to go down. So
yeah, I think we can't get away from the fact that there is a cost associated with trading one currency for another. So there does need to be a margin in there. The question is, what's the appropriate margin? And ultimately, I think that's decided by the customer, right? When I go to an airport and I look at the board as to what the rates are, and I say, well, do I wait till I get to the hotel, or do I go to an ATM and take the money out of there? The good news is you have transparency. You can look at the board, or you can go to the ATM, and you can look at the spread, and you can decide, all right, which one is better.
And that's the key. So what Swift GPI is going to do is provide that level of transparency, and that's going to drive the marketplace to, with that information, to require and ask for a different set of pricing. And I think that ultimately is what's going to drive it. But if I come back to who's going to continue to participate in the correspondent banking industry, any bank that goes too far is not going to have the revenues to support the kind of investment that needs to be made. So it really is a balance. But the transparency from Swift GPI is going to make a huge difference in at least educating everyone about what it is right now.
Thank you so much. So we're coming to the end of the session, but I just wanted to pose one more question, which is, what do you think will be the big discussion topic a year from now at the Toronto Sibos? Anurag, can I start with you first?
Yeah, I think there'll be a little more momentum around GPI. As was mentioned, it's only about a year or less than a year old. There's going to be, we're going through pilots, so we're actually executing some transactions through it, so there'll be initial experience around it. So there will be some good wins on that. There will be differentiated levels of service that correspondent banks start providing to different types of customers, potentially different message types emerging on different types of transactions like remittances versus business transactions. So there will be more around product functionality and features to talk about than the dull and dreary world of compliance and financial crime. Exciting, but it has been tiring over the last 3 years. I hope that will be turned around next year also, as it has been to some extent this year.
Okay, great. Bill?
Yeah. So maybe something similar, but I would say, with the test transactions and going through, I think this is now a question of how do you build momentum and really scale it. So how do we get this out of the lab and into the wild?
Peter?
Yeah, so I think blockchain is probably going to continue to be a topic that you're going to talk about next year. But if I bring that back and talk more on the GPI initiative, I think it's going to gain momentum, like we've said. And I think you're also going to see, with that momentum, more of a pressure from some of the bigger corporates to not only have the transparency in terms of a dashboard view, but give me the raw data so that I can take it and do what I want with it as well.
Excellent. Greg?
I think security, which I know is on everyone's mind, and especially in the last, let's say, year or so, that will be a much more vocal and visible topic next year, because I think it has to be. I know we're just scratching the surface, and I commend Swift for putting in place the client security program, but I think there's obviously, I think we can all agree there's a lot more we need to do there. And I think the expectations that today consumers have of credit card companies, in terms of those companies being there to spot and track and report any illicit activity on their account without them even knowing it, I think that those levels of expectations may find themselves or find their way into this space, as unfair as that might seem. So I think we need to think about, again, going back to the end customer, what are they expecting? Are they expecting us to do a better job at not only moving the money, but figuring out when it's about to be a problem?
And Susan?
So I'm going to make a bold prediction that there are 33% fewer banks on the exhibit hall. And I apologize to Swift for saying that, but replacing them will be a number of very, very small exhibitors that represent new players that are testing what they're doing and that the banks are working with to actually deliver some interesting new services.
Excellent. Well, I think it was a great panel. Please thank my panelists for their insights today. Thank you very much. That's a great way to end it.